Welcome to the Game of Finance. Today I'm here with Gavin Kacic from Evoke Capital. He is our head of credit and operations. Welcome, Gavin.
Thanks, Matt. Thanks to be on today's session. It's really looking forward to today's conversation.
Thank you, mate. I think what would be great is just to understand a little bit about your background and what brought you to Evoke Capital and what you did prior.
Yeah. So my background is all main bank from the day I left school, essentially. So started out retail bank, a CBA, and then I was a commercial portfolio manager for a long time, 12 or 13 years, across many different industries. So it really gave me a great base to project my career from there, I guess. My last role was in a strategy role as a head of schools and not-for-profit with the CBA. Great role, really fulfilling, being able to give back to different sort of segments and different type of industry, but also learnt some invaluable lessons from having that role and that deep expertise into those sectors. Also been able to realise how transferable those values and the skills are into many different sectors. So that was my last role. I did that for probably 3 years and then joined Evoke with yourself and the team August last year. So I'm coming up 12 months.
Fantastic, mate. It's gone quick and I'm stoked to have you as part of the team. You know, the type of clients that we look after very much have a need for that commercial type of experience, being business owners and property investors. So after courting you for many years and many beers, it's great to have you as part of the team and doing some great work, really expanding and deepening the skill set we're providing to clients. In terms of the type of clients we look after, Gav, what's been your experience over the last 12 months around the type of clients we look after?
We're really lucky. We've got a great client set. We've got a lot of different diversity. So we have first home buyers, basic resi, upgrades, which is awesome. And our team love doing that. And there's a lot of value in that. And then we have really complex sort of commercial clients, complex property investors who use many different entities and different vehicles to grow their wealth. But then, like I said, we've got some commercial customers across different segments, and we've got working class businesses, trading business, into property development, up the New South Wales South Coast, North Coast. So there's a bit of a range there, which keeps it interesting, but also allows us to build the capability of our group, of our team, so we can just deliver more value back to our clients.
Fantastic. And I think today what I'd love for us to cover is, some questions that we get from our clients, and some of the, I guess, themes that we're seeing from, resi investors, commercial investors, and the conversations that we're having to help them navigate, these challenges or forks in the road that they're looking to progress from. So I'm really looking forward to today's chat.
Yeah, so we've also got a really diverse customer group, a big business now with over 1,000 clients. But to yourself, you've bought business, you've bought property. Would you do it again? What would you do differently? Have you enjoyed the journey?
Look, it's a great question. Would I do it again? Yes. Have I learnt a lot? Yes. And I think a question that I've probably been asked a few times is, would you buy a business or property first? And I think for me, buying property first is absolutely the right way to go. Buying a business with little to no experience is tough, and you need a significant amount of capital to be able to make that acquisition work, depending on how you're looking to acquire debt. So for me, as part of my journey, I bought my first property at 22, which was using all of the cash that I had saved, but getting that footing in the market enabled me to buy the businesses that I bought, later in life. So for me, buying the property first, I think, is absolutely key, because that's giving you then the equity and time to leverage to be able to put those business transactions together to be able to make it make sense later in life.
Yeah, great. And there's so many different ways to skin a cat, right? And what we do now in terms of financing and picking the right vehicle and designing the finance the right way can just open up so many opportunities for people and for their next acquisition and the one after that. So making the right decision now is critical, but getting the right advice certainly puts you on the right stead. We see a lot of our clients are investors. We have a big, heavy investor book. Rent vesting versus owner occ is a common topic that we get. What's your thoughts? Is there wealth to be created either way? What's your view on rent vesting versus owner occ?
Well, rent vesting versus owner occ, it really depends on the individual and a few factors. One, it's how much income are you earning and what does your serviceability runway look like? If you don't have the longest serviceability runway, you really want to be framing the position to the lender that's going to give you the most amount of lending to take and build that capital base or that asset base. If I reflect on my journey, while I was a banker at Westpac for 13 years before becoming a broker 5 years ago, I probably thought I knew more than I did. But unfortunately, I had the blinkers of Westpac on. I didn't understand the full market and what was out there from a lending and a policy perspective and what structures were available to actually help me grow my portfolio at a quicker rate. So for me, I think rent vesting versus buying an owner occ, it's really about understanding your capacity. Once you have the information to understand what your personal capacity is, your company or trust capacity, and your self-managed super fund capacity, that's when you can make informed decisions. And that's when you can engage your advisors to make sure you're getting the best advice to hit the goals that you'd like to hit.
Yeah, so I think there's more to dive into the rent vesting structure, particularly around Sydney. For people that want the lifestyle, but obviously to buy into that market is extremely expensive. How does rent vesting allow you to buy additional properties that are going to give you the capital growth that you spoke about while still maintaining the lifestyle that you're looking for?
Look, it's a great question. And I think once you've understood your capacity, it's then about understanding your opportunity cost. If I was to buy an owner-occupied property, how much capacity is that taking off the table that I could look to use to invest? Because if it's taking too much capacity off the table, then potentially buying an owner-occupied property is not for you because you're not going to be able to hit those investing goals that you would like to hit. Therefore, if you were to rent a property and invest, and your capacity there is going to be much higher, and we could leverage different structures to build a larger capital base, then potentially that's going to be right for you. But it's more about understanding, where do I want to live? How much is that going to cost me to rent? If I was to buy an owner-occupied property, how much is it going to cost me, and how much capacity is that going to take off the table, and how much is that going to take off my investment goals? So I think the decision versus rent vesting or owner-occ, it's nuanced, and it's really about understanding capacity and opportunity cost. Once you understand those two factors, you're going to be able to make better decisions around what's going to be best for you.
Is rent vesting for everyone?
No, I don't think it is. I think it's a great strategy, and I think it's a strategy that I've employed for a lot of my life, and I found a lot of value from it. But if buying an owner-occupier property is only going to set you back $500,000 and you've got $3 million worth of lending capacity, then buying a $500,000 home to live in, where you may be renting a property for a similar amount of weekly repayment, you're not going to be getting a significant benefit there. You really want to see a significant difference between the repayments you'd make on an owner-occupier property versus the rent that you'd be paying to rent an owner-occupier property off somebody else. So again, it's about understanding, what are your numbers, what are your goals, and ensuring you've got the right team of advisors to leverage from to make those decisions.
How important is interest rate when we're looking at a rent vesting type structure?
Look, interest rate, I think it's important when we're looking at an overall position to put together a recommendation, but it's not the be all and end all. For me, interest rate plays a part in the discussion, but it's not the only motivator for moving banks. For me, I would much rather look at a client's position where we can access an extra $100,000 to $300,000 worth of lending to get them into a better quality asset versus taking on a loan product with a lower amount of serviceability that has a 30% sharper rate or 30-point sharper rate. Also, policies, that there's different policies or different products or structures that we can use at certain banks that we can't at others, which need to be factored in to the conversation when we're talking about what's going to be best for that investor. So for me, again, it's about coming back to what are you trying to get from your investing journey? How can we use the different banks and different valuation outcomes and different policies to get us there? And then rate's absolutely a consideration after we look at valuation outcomes, after we look at policies, to get and really hit our goals, and then we look at rate.
Yeah, and you touched on it there, valuation. So such an important lever in what we use. We've had some great success recently with valuations through major bank. but it also shows the disparity between the major banks in terms of what an outcome one bank will give us compared to the next. And that can just hamstring you in terms of opportunity.
So valuers aren't all created equal. And ultimately, it's the banks that drive the valuers that are engaged to get the valuation outcome for your property. So what we find works for us is we run between 3 to 5 valuations for each property of our clients. And the reason we do that is we've seen such significant differences in valuation outcomes. And it could be anywhere up to 30, 35%. So for us, again, it's not about interest rates. It's not sometimes about policy. Sometimes it may be valuation outcome and us being able to leverage and get access to a lot more funds purely because our valuation has come out at a much higher level versus, say, the incumbent bank or a bank that we've explored previously.
When is the right time to buy?
Great question. Great question. I think the right time to buy is when you can afford to. It's when your serviceability matches the deposit that you have together and you can bring them together and you can find a property that fits what you're looking for. A lot of times people cost themselves a lot of money trying to time the market. You know, there's economists out there that get paid a lot more money to make these decisions, and a lot of them over the last 4 years have been wrong. So for me, there's no way to time the market. It's really about understanding what you can afford to repay, understanding what your deposit level is, understanding where they intersect, and then taking action, because the cost of not taking action can cost you so much more money than trying to pick the right time to invest.
So how are sophisticated buyers or investors doing it today? So we've got clients that have multiple properties on a standard sort of wage, basic sort of median wage. How are sophisticated investors doing it?
Sophisticated investors today, they understand their position. They understand what they can do from a personal, from a company or a trust and an SMSF lending perspective. And they understand what would happen if they were to sell an asset too. Because oftentimes people buy a property and they hold on to it for far longer than they should if they bought a property that really isn't going to give them the performance that they want long term. And what we encourage people to do, and what we do as part of our review process, is we sit down and we review and we analyze your portfolio. We look at what's performing well, what's not performing well, and we work with your advisors, being your buyer's agent, your accountant, your solicitor, to understand where that property sits within the portfolio. Now, if there's room to optimize the portfolio and redeploy that lending elsewhere, if selling an underperforming property is something you're looking to consider, you then again have more optics around what you can do for the next purchase. And perhaps the next purchase with the sale can actually take on a much better asset that's going to perform better over the longer term. So to answer your question, I think what sophisticated investors are doing is they're informed, they understand their position, they're bringing their advisors along for that journey to be able to make the right decisions to the benefit of their portfolio.
Yeah, I think it's a great comment. I think it's worth unpacking a little bit more about choosing the right investment at the right time and picking the right vehicle to do so. So we have some clients that have owner-occupied houses looking to upgrade because they've created some equity or needing to relocate or those kind of things. And it's always the question is, do I rent my owner-occupied house out or do I sell it and put the money into something else? Because there's value either way, right? So owner-occupied, you have your capital gains exemption because it was an owner-occ, yet there's potentially not the capital growth that you could make in an investment somewhere else. How do you determine which is the right way to go, and what are our buyer's agents kind of telling us in terms of where's the value?
Look, it's a good question. I think for me, it sometimes depends on where the asset is. Is your home a good investment? Take the rose-colored glasses off and look at it through an investment lens. Would you buy that property today standalone if it was an investment you're buying today? Secondly, you want to look at the level of gearing or the level of appreciation that asset has had. As you mentioned, owner-occupied properties are CGT free. So you're not paying any tax on the upside from that home that you buy if you've had, $200,000, $300,000, $400,000 worth of growth. So what I look to ask to our clients is, if you've got a property worth $2 million and you bought that 3 years ago for $1 million and you've only got an $800,000 loan against it, you have $1.2 million there of equity that you could realize if you were to sell this property. and we could put that cash into the next owner-occupied property and reduce our future non-deductible debt by $1.2 million. Now, if you hold onto that investment and you've only got $800,000 worth of debt against it, that debt is going to go from non-deductible to deductible if you choose to rent that asset out. So the question we need to be asking ourselves is, what is the long-term plan? Are we looking to buy another owner-occupied property in the near future? Are we looking to rent-vest? Are we looking to potentially move to another state? I think we need to understand the decisions around the next purchase and why we're looking to do something. But more often than not, I would encourage people to get advice from their accountant or a solicitor, but where I see us landing is selling the owner-occupied property. Because if you've got $1.2 million of cash tied up in that asset that's CGT free, and you intend to buy another property, then you should be liquidating that asset and you should be putting that cash into the next one. We look to borrow the difference so we have less non-deductible debt on that property, and then we leverage that difference in that home that we just bought and use that equity for deposits on future investments. Now, again, it's not a perfect science. It's not one size fits all. It's about understanding your goals, getting that right advice, and then putting a plan together to execute.
How important in that type of scenario is being a little bit creative around the structuring of your debt facilities?
Oh, look, I think it's incredibly important. You want to ensure that you're giving yourselves all the options you can. Again, you need to be comfortable with the amount of debt that you hold. There are ways that we can use lease stock facilities. We can gear up in trusts or companies, but ultimately you need to be able to pay that debt back. So it's important that you know your numbers. You understand your cash flow, what's coming in, what's coming out. You've got your buffers in place, and you are confident in your ability to service whatever debt you look to take on. But in terms of using structures to be creative and build out more options than you would have if you traditionally borrowed in your personal name, it absolutely has a place for the bullish investor or the sophisticated investor. But you need to know that I can pay this money back. I've got the buffers in place. I know what my cash flow is, or I'm confident that my cash flow is going to increase in the short to medium term to fund that debt long term. Because we're not buying property for 5 minutes, we're buying it for 10, 20 years. It's a long-term play. It's a boring way to get rich, but history proves it does work. So it's one of those things where you just need to be informed.
Another really common structure that we use a lot is debt recycling. Talk us through the debt recycling concept and how that can open up some different avenues for you.
Again, debt recycling, I think, is a sexy word. You've seen it on Instagram and TikTok a lot, but simply debt recycling is paying back non-deductible debt. So let's just say a home loan debt. We're partially paying that back. Then we're separating that loan into a fresh loan, and then we're using it for a deductible purpose. So to put some numbers around it, you've got a home loan for $500,000, you've got $100,000 in cash. We look to pay that home loan by $100,000 down to $400,000, and we're then giving you that $100,000 back in the form of a new interest-only line of credit that you're using for a deductible purpose. So why is it good? Ultimately, we want to reduce our non-deductible debt and increase our deductible debt over time, because every dollar of interest we pay on our deductible debt, we're getting a benefit back from the ATO. Every dollar of interest we pay on our home loan debt, we're getting no deduction back from the ATO. So for us, it's really in our best interest to try and get money out of our business or our role as best we can in a tax-effective manner, and then look to accelerate the repayments on our home loan as quickly as we can. We have multiple rapid amortization strategies that we use for our clients, which include paying directly into the loan, potential tax withholding variations to look to accelerate those repayments. But then it's about using that equity smartly. So whether it's looking to invest in stocks, whether it's looking to invest in a business, whether it's to invest in commercial or residential property, the debt recycling doesn't work unless you use it. So it's important to have a strategy, but then also execute to get that benefit.
Let's talk a little bit about the difference between residential and commercial. So we have some clients now starting to consider the commercial property game. They've been through the resi for a period of time, and it's been great to build their portfolio and create wealth. But now they're wanting to shift or pivot into a different asset type, which is going to grow more at a consistent yield and give them the ability to manufacture a bit of equity around lease terms and whatnot. Talk to us about the right time when it is to switch from resi to commercial, and if it's going to work for a particular type of investor.
Again, I think the right time is, when you've built a strong residential base. The way I view investing is that residential debt, it's cheap and it's relatively easy to get. You can get higher leverage than you can on commercial. And from a valuation perspective and accessing additional equity, that the costs are low. So for us, what we see is about creating a solid foundational portfolio that's spitting off equity per annum that we can access. Again, we want to make sure we can access it by having the appropriate structures and serviceability runway. And then it's about pivoting into commercial to look to enhance our overall portfolio yield. So commercial property, you're getting 6 or 7% net return depending on the asset. So that's a true net because the tenant's paying all the outgoings, they're paying the land tax, whatever you've looked to build into your lease, generally the tenant is paying those costs. Where on the resi front, you're getting 3 to 4% gross returns. Sometimes people may be manufacturing yields up to 5, 6, 7%, but again, it's still a gross yield. You've still got land tax, you've got insurances, you've got agent fees to pay. So the yield profile on resi versus commercial is very different. Where we see people transition or switch, it's when they've looked to already build a really sizable residential portfolio and they can leverage the equity to move into a commercial portfolio. Now, a lot of the value in commercial properties is generally over $3 million. Anything under $3 million, it's quite competitive. There's still some great assets out there, but they're harder to come by. So we see a lot of our clients that are going up the deal curve are getting value between the 3 to 10 space before you start to hit the institutional investors that are around 15 mil plus. So for us, it's about really building a really solid residential portfolio and then transitioning to optimize your yield. For business owners, it may be looking to diversify the income risk for the family away from the business into commercial property to be able to build a more passive type of return. And there's also tax benefits there as well, where you're potentially leveraging money that's sitting in a bucket company where you've paid the 25, 30% corporate tax rate, and then you're investing that into a commercial property and it's positively geared from day one. Because if you're gearing commercial property at 70% LVR, you put a 30% deposit down in cash, that's paying you an income straight away. And some people elect to actually pay the principal down to enhance that yield over time, or potentially leverage that to pay off non-deductible debt, or potentially to save for a deposit to buy a future commercial property. So again, there's no exact perfect time, but what we see is most common is that people look to build a foundational resi, look to move into commercial to optimize their yields, but also look to diversify away risk from the business.
Talking about commercial property, we have some clients thinking a little bit creatively about what they want to do. So what would we go? There's a couple of different angles we can go. We can buy and hold for the long term, 15, 20-year plan, retirement sort of building, or we can look to do some development, 2 or 3 townhouses, a little bit more potentially, depending on the size of the site and the location and the experience of the builder and whatnot. Talk to us about the different angles that people can go down and sort of pros and cons to both.
Yeah, look, I think it's very much an active strategy versus a passive strategy. An active strategy with development is the acceleration of cash, the velocity of cash. How can we turn, $1 into $1.20 with a 20% return, ensure our feasibility stacks up over time, versus buying and holding and getting that equity uplift over time and then accessing that equity tax-free, because we don't have to realize the sale of the asset. So I think each strategy plays a role depending on the investor, how active or passive they choose to be. More often than not, recently we've seen people get better returns from buying and holding because the cost of building is so variable. Construction today is really expensive, so it's hard for those feasibilities to stack up versus what it was like, 4 or 5 years ago. But again, it's about, do I want an active strategy or a passive strategy, or is it a hybrid of both? We've seen a lot of people look to buy and renovate their owner occupied with a development lens, where they're going to buy, they're going to develop, they're going to manufacture value, and they're going to potentially sell that asset in 3-4 years time, capital gains free. And then on the side, they're also buying and holding. So they're getting the best of both worlds. But I think, again, there's no one way or one size fits all. It's really about understanding, what you want to get in terms of your end game, and building a strategy to get there. And whether that's buy and hold long term, whether that's purely development, whether that's a hybrid of both, we are here to facilitate all and give advice on the pros and cons of both. But again, it's about understanding your goals, understanding your opportunity cost, and just making sure you've got the right pathway lending wise to bring that together.
So we're getting increasing inquiries from clients and referrals that we work with about SMSF. Reason being is it may enable the buyer to get into an investor where they otherwise wouldn't, because it's not funds coming out of their bank account. It's money that they've otherwise got put aside by their mandatory contributions, a little bit of a top up if they can, but it allows them to get into an investment where in their own name they may not have the capacity. Talk us through SMSF, some complexities around SMSF and how it could be an enabler for some of our clients.
Well, I love SMSF. I think SMSF is a great strategy for investors who are conscious of not wanting to lose too much of their take-home income from their budget. So I guess what investors are now realizing in the increased rate environment is that to hold property when you're funding it 100% with debt, which oftentimes we do, we're accessing equity from an owner-occ or an investment to acquire the new property at 100 or 105% LVR, is that they're needing to pay a significant holding cost to hold it if we're getting a 3 to 4% gross return for a residential property. So I think SMSF's a great way to be able to acquire property without having that holding cost that impacts the family budget. It's a great way to squeeze another property into the portfolio if you've have hit the servicing wall and you're not sure on how much further debt you can take on. But again, I think people having to make that decision need to probably rewind and have a look, at where they may have gone wrong from understanding that capacity perspective. And again, this is conversations we have all the time, is you need to know your numbers. Once you know your numbers, you can make really informed decisions. I love SMSF. I think it's a great way to leverage the cash sitting in there via an alternate investment to shares. Again, you get to use leverage to turn $1 or $2 into $10 with debt versus having that $1 in super that's getting a return on that $1. So I think, using super is a great way to enhance the returns in your super fund potentially. Again, you want to make sure you're getting the right advice, but you want to see how that structure fits in with your holistic investment strategy. If you're a resi investor and you're only buying resi, then absolutely it could be a great way to use those funds. If you're a business owner and you operate out of a premises that you may want to purchase, perhaps it may be ideal to buy that business, buy that commercial property through the self-managed super fund for the taxation benefits that you get, and potentially the exit plan benefits that you get over time by potentially being able to sell the business and keep that asset and dial the rent up to dial up the asset value of that property. So love super. I think it's great, but you just want to use it at the right time. So Gav, final question. I'd love to know from yourself, what's the one piece of advice that you would give to a prospective borrower looking to borrow money in 2025?
The one thing that I would take away is to be prepared. Think about all the options, because there are lots of them, but to get the right advice. Really important that you're speaking to the right people, whether that be your broker, whether that be your accountant, whether that be your buyer's agent, your solicitor, to ensure that you got the structure right. That's not only going to enable you to do what you want to do today, but what you do today is really important around what you want to do tomorrow. So I would really think about talking to the right people, having a 5-year plan, and going, how can we build ourselves up properly today to ensure that our 5-year plan can be executed.
Amazing. Gavin, thanks for being here.
Thank you. It's been great.